The Energy Industry Explained, Trends, Pressures, and Possibilities, a conversation with Jim Burke. If time allows, at the end of the session, the panel will take questions submitted by the audience. To submit a question, please scan the QR code located on the screen. Please be sure to silence your cell phones. Enjoy the conversation, and please join me in giving a warm welcome to our moderator, Paulo, Dean of the Tulane Freeman School of Business.
Thank you.
Good afternoon, everyone. Thanks for being here for this exciting session. I understand we have a faculty member from the Freeman School who brought his students and his teaching strategies, so what a great session for them to be exposed to that. So welcome. My pleasure to introduce our speaker today, Jim Burke. He is Vistra's President, Chief Executive Officer, and a member of its Board of Directors. Vistra is a Fortune 500 integrated power generation and retail electricity company based in Irving, Texas, with operations across the U.S. from California to Maine. Burke has been with Vistra and its predecessor companies since 2004. Serving various leadership positions, including Chief Financial Officer, Chief Operating Officer, and Chairman and CEO of TXU Energy, the company's retail subsidiary and leading competitive retailer in Texas. I'm very proud also to say that he's an alum from the Freeman School, and he is, I believe, the only alum of Tulane that holds the CEO position in a Fortune 500 company. We're very proud of that accomplishment. He is also a member of the advisory board of the Tulane Energy Institute. He's been a great friend and supporter and partner of our school. So with that, I'd like to ask Jim to tell us a little more about himself, his journey, and how the Tulane degree helped shape that journey.
Perfect. Paulo, you could not have given a more gracious opening. It's an honor to be here. Drew Marsh mentioned that we were in meetings actually as part of nuclear just yesterday, but what was interesting is we were actually in a class in 2017 at MIT. It was for nuclear for folks that don't know nuclear. And Drew and I are in the class. It's 3 weeks. You don't get to go home. You have to do your homework assignments. You turn them in the morning. And then yesterday we were in Atlanta at NEI, and he said, did you think taking that course would lead us here where he is chairing and I'm the vice chair of the Nuclear Energy Institute? And I share that story because that's what Tulane did for me. I grew up in Baton Rouge, Louisiana. I'm actually a product of Exxon, and before actually even the Mobil acquisition. My dad worked on the chemical side, and my brother worked on the refining side. And I was fairly confident I would not end up in energy. So I actually went through the economics program. There was a 3-year program coupled with a 2-year MBA program. And I actually came here, and I see one of my good friends in the audience, Bill Hammerstrom, who's on the advisory board. I actually came here, and I was trying to play baseball and run track and cross country while going to school. And what I found is I think I could contribute on the track and cross country side, but much harder for me to contribute on the baseball side. So I sort of got this competitive streak, going in college, and it sort of continued because when I left Tulane, I ended up at Deloitte Consulting. I moved to the Minute Maid Company, which is part of Coca-Cola, and I really loved the competition of brands and products that had to differentiate in the minds of customers, and that business was based in Houston. So living in Houston, I had a chance to move from an oil and gas economy to one of the few consumer product companies that existed in Houston at the time. Then the market opened up to competition. So when Texas decided, 10th largest power market in the world, that it was going to allow choice for consumers to have a choice of who they got their electricity from, and they had already passed the laws that anybody could build a generation plant in Texas. If you want to build, and that's still the law, if you want to come build a plant in Texas, you're more than welcome to build a plant. Well, this is during the dot-com era, but I looked at it as this is a ground floor opportunity where you've already got a product, you've already got a huge market, and the incumbents at the time, Reliant, who is still based there in Houston, is who I joined. There were folks from the Minute Maid company had already moved over to Reliant, and I didn't know a thing about energy, but what I knew was that customers have the right to choose, and they're going to express that choice, and if we can provide a differentiated product better than the next guy, I don't need to invent the category. The category is already there. People need electricity. I just need to be able to differentiate versus others. That was the year 2000 when I joined the industry. I've been with this company, Vistra, since 2004, but most folks would know it as TXU Corp. That was the company that was a fully regulated, integrated company based in Dallas. So as you noted, I've had a number of different roles. It's been an exciting journey, and I'm sure we'll talk about where do I see this thing going, but it really was eye-opening for me to be at Freeman. I didn't think I'd be at Tulane. It was a rare opportunity for me to come, and then the MBA program exposed me to students that were older than I was, had experiences in many different industries, different parts of the country, and I just felt it opened up possibilities for me to ask more questions and just sort of ask why and why not. And I think that's sort of been the approach I've taken to my career.
Great. The students are noting that, right? So you mentioned Vistra, which operates in a competitive market. It's different from, you all heard about energy in the previous session, which is a regulated market. So there are major differences there, right? Yep. And I also understand that Vistra does power generation and electricity distribution. Yep. It's kind of integrated. So the other thing, I was very impressed with Vistra. I mean, I was asked to moderate this session. So the first thing I did, I looked at the stock prices, right, of Vistra. And in 2 years, the Vistra stock was, 2 years ago, it was trading the 20s. Now it's trading the 200s. So what is the explanation for that? And then, of course, it's a Magnificent Seven kind of a performance, even better than some of those Mag 7 companies, right? So what's the Vistra's story? Everybody knows that electricity demand is growing. What's behind that? Elaborate on the Vistra's story.
There is a lot to unpack with that question. So let me start with, I think, the transition for the company, because the company's evolution, and by the way, I shout out to my team here, raise your hand. Here are members of the Vistra team that actually are here engaging with students. So thank you all for coming and making the trip here. I'm glad this all coincided. So the company, being a Texas-based company and having to deal with competition, the first ownership group, we were a publicly traded company, the first ownership of our company that was different was when we were taken private by KKR, TPG, and Goldman Sachs in 2007. At the time, the largest LBO that had been done in the United States. That deal looked good for 1 year. So from 2007 to 2008, power prices moved up. And then Bobby talked about fracking. And fracking came in, that's a very, it's really the brilliance of engineers in a competitive market in the oil and gas space, finding better, faster, cheaper ways to get to gas. So power prices went down. We had 7 years of hedges on the business. So our business looked stable for 7 years. The 8th year, 2014, we had to file for Chapter 11 because the hedges were over and natural gas prices were sub $3 and power prices were sub $30. So we go in with $35 billion of debt, we come out with $3 billion of debt, and we said we're predominantly coal, 60 to 70% of our generation was coal. We had 1 nuclear plant, we served about 2 million customers. So we embarked on first our name, Vistra. It comes from tradition, which is 40 years of folks working at our plants that have built Comanche Peak, run the coal plants, run them well, but also vision. We had to actually change the way we were doing business and plan for the way the consumer wants to see the product delivered. So vision and tradition, we rebranded the company. We did not want to be a geographically limited company. Then my predecessor and I and the leadership team, we bought Dynegy out of Houston. That gave us nearly 20,000 megawatts of combined cycle generation, and at that point we had only bought 2 combined cycle plants. That made us one of the largest fleets in the nation. Then we bought 2 retail businesses, and then, interestingly, I'm gonna tie in the Burke Road reports, the students came to see us in April of 2023. We had just announced the acquisition of 3 nuclear plants in Ohio, 2 in Ohio, 1 in Pennsylvania, and that was the former First Energy fleet, then called Energy Harbor. When we made that announcement, our stock moved from like $23 to like $27. The market liked the announcement, and the Burke Road team came and they said, we like it too. You did it a month ago, so we're gonna put a stock price target on of $31. I was like, I'll take 31. We haven't seen 31 yet. It's been hard to get out of the 20s. When we IPO'd, we were at 14, so we had gone up a little bit, but not much. Fast forward 2 years, they came this past April. DeepSeek came in February and kind of revalued for a moment what the AI space was going to do. And then we had the tariff announcements, and our stock went below $100. And the Burke Road team is there in front of us. And they said, well, we still like the business. Your stock was about $200. Now it's $100. What do you think it's going to be? I'm like, I don't know. I can't predict our stock price. Well, they went out and put a $200 stock price target. They stuck with it, and they had the previous target, I think, was around $70 that they did in 2024. So actually, credit to the students. They actually had the fortitude, maybe more so than management, that this stock was going to return to that value, and within 3 months, it did reach that. To your question as to why, when we bought the Dynegy fleet and had a large stake in natural gas, most of the market was moving towards renewables. The natural gas fleets were devalued across the country, and you could pick up gas fleets for, I'm going to use numbers that some of the students will know, maybe most of the audience will know, but let's say $400 to $500 a kW, you could buy a gas plant. To put that in perspective, it costs, depending on whose estimates, $2,200 to $2,500 to build a combined cycle gas plant today. So we were somewhat buying when others were selling, and we were being told by the public equity markets we'd never get value in dispatchable generation. You need to move everything towards renewables. Well, we have renewables. We have big solar farms, big battery farms, but our view is that dispatchable energy was underappreciated. So when the Energy Harbor plants, the nuclear plants became available, we said it's dispatchable, it's carbon-free. We're going in and we're going to put in a bid, but our stock value was so low that we didn't want to issue equity too cheaply, and we didn't want to borrow and re-lever ourselves into a situation that we had just been through. So we actually created a subsidiary that we put our retail business in, our solar business, our battery business, our existing nuclear plant, and issued a security in the subsidiary, and the buyers took half cash, half a subsidiary equity, and then our parent equity we protected. Right after that, part luck, obviously our view was electrification was the theme, our view wasn't AI was the theme, but we did view that long-term reshoring and electrification would be a tailwind. I think when you put that story together, the market, I think, is starting to come around, and Drew hit a lot of this earlier in his remarks. 24/7 power is underappreciated, and I think everyone's looking for the silver bullet of how do I get 24/7 power, and the fleets that we had been acquiring and some of the assets we built were really focused on 24/7 power. Where this ends up, I have no idea, but it has been, it's not for the faint of heart. Paulo, I'll tell you that you can't get caught up in the stock price. We make our decisions. We have an independent chair. I can tell you all of our discussions with our leadership team and our board is on value creation. What is a cash accretive business decision? If the market gives us credit for it in advance or they knock us for it, We can't worry about that. We've got to make good fundamental sort of cash-on-cash business decisions, and it'll sort itself out.
So gas was one of the reasons why.
Gas and nuclear, yep,
Nuclear.
for us. And now our retail business, we're not in, let me explain the competitive business for a second, because the business, the easiest way to think of it is 3 segments. There's a generation segment, that's competitive in the markets that we serve. There's a wires and poles segment, that's always fully regulated and not competitive and overseen by state commissions. And then there's the retail side, the customer choice side, and that is open where we do business. If the markets are not structured in a way that we can enter them, obviously we don't enter them. But since about half the megawatt hours in the country are generated by competitive generators, there's plenty of markets for us to participate in. And we serve nearly 5 million residential and small and large business customers. So we're on the generation side, but we also see the bill side of it, because we're billing customers and we're having to meet their needs. So we're very sensitive to the customer side of the equation, and I like being in both of those businesses, because I think staying close to the customer is ultimately critical to being ahead of whatever change you think is going to come next.
So on the customer side, you service 5 million customers.
That's households and businesses.
Households
Obviously,
and
there's
business, yeah.
multiple people at a premise, but yes.
It's about 10 times the size of New Orleans, just to get a.
I hadn't put it in that perspective, yes. Fortunately, it's geographically distributed too, because we're all in the weather business.
Yeah.
And it's actually good to have that geographic diversity across our business.
And on the generation side, I looked up, you generate 41 gigawatts of power.
Mm-hmm.
Yep. And that comes from several types of generation facilities.
That's right. We're acquiring 7 more gas plants that are combined cycle gas plants that we expect to close on by the end of this year, predominantly in the Mid-Atlantic region.
Yeah. So let's move to the topic of these very high intensity demand installations that, for example, the data center, the AI centers, some of the industrialization efforts here in Louisiana, for example, we have these LNG terminals that for the liquefying of the gas, it takes a lot of electric power. Hyundai is going to develop this steel plant with a technology that also is very power intensive. So these things are happening, right? Data centers, from the previous session, we learned about the Meta and others. Yep. So how do you balance, how do you position Vistra to address not only the residential customers, the offices, but also those high intensity demand points that are coming very fast?
Yeah, it's something that we've talked about publicly with our stakeholders, whether they're regulators, state leaders, investors. We describe this, and I think Bobby and Drew hit on this well earlier, but we describe ourselves as prioritizing reliability, affordability, and sustainability, and we say in that order. Now, that's a little different than just saying they're all equally important, but our data shows when we do customer research that reliability is the #1 issue for people, and the reason why you can sort of see that is if you live in a hurricane-prone area, people buy Generacs. So that wasn't the most economical thing for them to do, but they said reliability is important to me. Right close to that, though, and it's really close, is affordability. When you ask people on their preferences, you have to ask it obviously different ways, because if you say, where's sustainability, everyone will say it's important, but when you give them a force ranking and a choice, sustainability is always going to be third, and that's true anywhere in the country. The reason why sustainability was getting a little bit of a higher priority was because the reliability and affordability looked to be a given. And I'm going to get to this reliability topic about residential all the way up to large commercial. So there's a concern right now that too much coal is retiring. And the reason why Texas could get to 71% penetration on renewables one day, maybe be at 30, 40% the next day, is there is excess capacity sitting there in standby, usually gas or coal, that is there to fill in. Now, if it's a battery, we have We have over 13,000 megawatts of battery. That's filling in for the hour to 2 hours, but on a day's basis, there's this excess, and it generally tends to be older plants. What we're trying to do, and what we're trying to do by educating folks about the grid, is that we need all forms of electricity, but it really means all forms. It's really hard to replace one fully with the other. With these large customers in particular, one of the things I don't think is fully appreciated is the arc furnaces for the steel mills, and in some LNG facilities, and certainly the data centers, they're either going to be, in some cases, price responsive, so all the markets we serve have price signals. And someone says, well, what's a price signal? Is that what's on my bill? No, there's a wholesale price of power, and that wholesale price of power, we see variation every 5 minutes. When large customers see those signals in Texas, there's between 2,000 to 4,000 megawatts of large commercial load that will come offline without being part of any formal demand response program. It is purely customer self-selection. At that price, it is more economic for me to use less power and sell back power I might have already purchased. I can sell it back for more money, or I can just choose not to have the exposure because I'm on an index product. I'm a big believer that the evolution of this industry ultimately is going to have to bring price signals to the wholesale level and to the retail level, because we all respond to price signals. If you want an Uber and then you get a surge price and it's too high, you might check another app. If that's too high, you go, you know what? I guess I'll drive and I'll be the designated driver. Okay, we all respond to price signals. We do it with airfares, we do it with transportation. The electric industry has historically said, don't worry about what's happening behind the curtain. I'm going to charge you 12 cents a kilowatt hour. The whole microeconomic lessons I learned at Tulane was that you have to de-average and de-average and de-average and get to the marginal cost and the marginal benefit. And the electric market, and we see it happening in Texas and other states, when solar is at its peak, prices are zero or negative, and the batteries soak it up. And then when the prices go higher in the evening, the batteries discharge. That's not happening because of a PUC rule. That's happening because of prices. And I think we're going to have to see customers engage in a price relationship. And if you don't want to engage in that, you're probably going to pay a little bit of a premium because you're insuring your cost. If you're willing to engage, I think you're going to see customer response. And that could be within the home with devices, not your whole home. It's already happening inside business. The data centers specifically are bringing backup generation. And one of the things that folks are trying to work through are the state rules and the EPA rules that in the 1% to 2% of the hours per year that the grid gets really tight, can that backup generation be turned on? In many cases today it's diesel. They're looking at using more natural gas. But if you can solve those super peak hours, you can serve the rest of the grid by letting them run their backup. They need the EPA clearance and the local air clearance to do that a couple days a year. That has not been fully sorted out yet, but I think you can solve this reliability in large load through price signals, through backup resources, and through demand response.
That's very interesting. So you are a public traded company, and you, for the longest time, electricity demand was kind of flat. Now we have all these incredible peaks and all the different situations that arise from these large industrial installations. How do you incorporate that in your strategy as a public company?
You know, Texas, let me use Texas as an example, and I'll contrast it with the rest of the country and Louisiana. So Texas, when it embarked on this competitive market approach, today on the grid, it's about 60% more energy being consumed on the grid than it was in 2000. For the country, it's about 10% more. So when Drew said it's been largely flat, for the country, for Louisiana, it's about 20% more. But Texas has already had to deal with a big shift in growth, and that has already been at, like I said, 60% over the last 25 years. We see that rate, that compound growth rate of say 2.4, 2.5%, we see that moving up to 4 to 5%. That doesn't sound like a lot, but it is a lot on a big grid. And I think Drew's talking about numbers potentially even bigger for Louisiana. all the while, coal used to be 50% of the US electric grid's source of power in 2000. Last year it was 15%. The US electric sector has done more for decarbonization than any of the sectors, not transportation, not buildings, but the electric sector. The biggest portion of that has been the coal to gas switch. Unabated gas, I'm just saying coal to gas, and then the renewables has helped cover the growth that has occurred in the country and the growth that's occurred in Texas. What we tend to think about is, how does the grid physically work? Because you need to know, if I just add more wind and solar in Texas, its incremental value for that next megawatt hour is coincident with how the wind and the solar work with other assets around it. So we look for some uncorrelated assets. We look for where we see load pockets and where we think generation, like we've announced that we're looking to build, and are pretty far in the development process, build some natural gas plants in West Texas. West Texas has tons of wind and solar. It just doesn't have it every hour, and there's more that's happening on a 24/7 basis as oil and gas electrifies. So we look at that and say, price signals are saying that West Texas power is worth more than Dallas power. The market's telling us that. Let's put our peakers in West Texas. So we don't have to sit in front of a committee about getting them to agree to that. We have to just make a bet. And frankly, we get the bets wrong more than I would like. I'll give an example of that. In 2010, we went online with a new coal plant. We built 3 new coal units, 2 at one site and 1 that was an additional at an existing coal plant. Those plants we thought were 30, 40-year life plants. We made the decision in 2007. It came online in 2010. Fracking happened right in between, and by 2018, we had retired that plant. So 1 of the 3 units got retired within a decade. That was a $1.25 billion investment by our shareholders, and there's no rate recovery for that. That's what happens in a competitive market. We had a battery at Moss Landing in January that caught fire. If you've read about it, it's in Monterey, California. Overheating of a battery. That's on us. Now, we have insurance, but it doesn't cover 100%. That's on us. So what I would say, Paulo, is you have to have a sharp point of view and conviction to make the decision. You still have a decent probability you're going to get it wrong, but hopefully you get it right a little bit more than you get it wrong, and if you do, you have a decent business. But that's a fundamental difference in the model, and like I said, I think it's something that policy can affect, technology curves affect, obviously the economics affect, but I think it's why it's one of the most exciting industries anybody can be in right now, because no one knows the winner, because there probably won't just be one winner. And I think it varies even by parts of the country what might be the winner.
So I think you're referring to uncertainties, right, driven by regulations, policies, technology. Yeah. So how do we incorporate all of those? I mean, you mentioned you cannot be right all the time. You have to leave some cushion to be wrong.
You know, we just completed our strategy session with our board, our annual strategy session, and one of the exercises we do is we explain in our best way possible what are all the strategic options we put on the board, which ones move the needle, which ones are more like pilots, what's a big bet, small bet, and then we're asked to invert it and say, what if we're 100% wrong with what we've assumed in our recommendation, then how bad could it go? And you have that discussion, and it's an intellectually very interesting discussion, but the goal is to come out of it with a path where you as a leadership team and the board are aligned not just on the answer, but the process to actually get to the answer, because when the signposts change, because they can change before you actually get to full commitment, you have to be clear enough about your thinking to say, is that enough for us to pull up at the moment and think about an off-ramp or a pause? And I would say anybody who's in this space, you have to be willing to live with a degree of volatility. You have to have, I call it a high pain threshold, because there's no easy button. in this industry. And I say that about regulated, competitive. There is no easy button in this industry. But I think that's why it's intellectually stimulating, because you really have to turn over all the rocks you can and have a point of view. And we use the term insights. I'm always asking the team, what is the insight? What's the insight that we think we have others don't have? Which is different than, did you read this report? Well, if you read the report, everyone read the report. So that's a really important thing, is what is the insight? And then it takes courage to then defend the insight, because it's sometimes easier to not raise your hand, but we want to encourage debate. And we've got some really excellent people in our company that are prepared to say, yeah, I know that's what you think, Jim, but I'd like to offer an alternative view. And you're like, oh, okay, well, let's get into it. And you know what? We're always better off when that happens, because you either come out with more conviction, or you modify, or you give up the idea. I think I sent an email to someone just early this week, and I said, your email proved that my idea was a dumb one. Thank you. You know, but I think that is the encouragement you're looking for your team to push you.
Yeah, I wish we could teach that in the business school, right? Those strategy sessions and all the quantifying of the decisions.
There's still a gut, though. There's still a gut
we do
that's
teach
involved
them,
in it. I
right?
mean, yeah, you can quantify it. You still have to make a call.
So looking forward the next, 10 years, 20 years, so hard to pin down a number. You mentioned on the generation side, Vistra has diversified into renewables, nuclear, gas. If you were to predict the next 10, 20 years, you would stick to nuclear and gas as the core generation technologies?
You know, part of the challenge, and I think the oil and gas industry tries to communicate this, and it's hard, is people don't have a full sense of the scale of the embedded base. And even if you said, let's go tomorrow and never build another gas plant or nuclear plant, the turnover time it takes, because our industry, people like to think about digital disruption, but our industry has real safety considerations, real environmental considerations, real land use and permitting and right-of-way considerations. Those things aren't solvable just through code. And so what I think about our business is we're going to be in some of these long-lived assets. Fortunately, nuclear was retiring at a pretty alarming rate, and now you're seeing the existing nuclear fleets get extended to 80 years, and there's a potential for them to go 100 years. Drew mentioned earlier, we think new nuclear is critical. I don't think it's easy for the hyperscalers today to think about new nuclear as delivering what they need for their data centers in mass quantity in the next 5 years, and it's even hard to get there in the next 10 years. But they're engaging in that topic, and I think they want to see nuclear proliferate. And I think both large scale and small modular reactors. It came up earlier, Bobby mentioned it, Drew mentioned it, but 40% of today's electric grid is powered by natural gas. The 15% that's coal is going to continue to come off. I just don't see it. It's older. It tends to, from the standpoint of reliability, be a little bit more challenging as it gets older. And we have high fidelity, high reliability with natural gas units. So I think you're going to see natural gas's share stay where it is or potentially even go up. I think over time we'll abate the natural gas, and I think there's a commitment by many companies, and many certainly technology-leading companies, to make CCUS work with the existing gas fleet, not just new gas, and new nuclear. The energy density that's coming from these gas plants and the nuclear is just really hard to substitute. And while we're one of the largest wind off-takers in Texas, and as I mentioned, we have large solar and battery farms, our math has shown us that if I'm solving reliability first for customers, then affordability and sustainability, to have an equal amount of reliability on the Texas electric grid, I need 9,000 megawatts of wind, solar, and battery to equal 1,000 megawatts of coal, gas, or nuclear, okay? That doesn't even factor in the cost of transmission to connect all of it. So if I'm solving for reliability, I have one equation. If I'm solving for just the cheapest megawatt hour, I can put up a wind farm or a solar farm. You just need to take the power when I produce it. So the bid-ask spread is quite large between take it when I produce it and I hope it meets your needs versus I guarantee you the 24/7 reliability. I just don't see, from our view, that gas and nuclear are going to have easy replacements, even if we get long-duration storage. Once you put all the costs of those together, it's actually not as competitive as just committing to the nuclear and the gas if you look at it on a system-wide cost basis. But on a single asset-by-asset basis, you can actually make the case that wind and solar are cheaper, but it's not delivering the customer view of the product. It's a production view of the product. The customer view of the product is 24/7 reliability. That's why I think we're going to stay focused on those assets and continuing to optimize the gas and the nuclear.
So you mentioned grid reliability, stability. How do you address the increasing rate of national disasters, storms, winter storms, wildfires? I mean,
well, I know I'm supposed to be supportive of our equity price, but we've had trouble with winter storms. I mean, Winter Storm Uri was a real kick in the gut. If you lived in Texas in 2021, we had over 200 folks lose their life, directly or indirectly related to the cold and loss of power. Our company specifically, as a competitive company, our fleet actually ran on average better than the market's fleet, but not to the level that we had hedged the output. So we had to go into the market and buy spot power prices, pay spot power prices to cover our customer commitments because we don't have a force majeure with the customer. So when all was said and done, Paulo, we lost $2 billion in 3.5 days, okay? That also is not in a storm recovery or rate recovery. Our shareholders took that loss. I don't think the customer should pay for that loss. That's on us. So the winterization efforts that we've gone through, the dual fuel that we've installed, we've had to put fuel oil in addition to where gas is feeding a pipeline because some of the challenges in Uri, not all, was pipeline pressures were dropping and we could not run plants that were fully online at 100%. So we're doing hardening, but all of that hardening, we're having to make a cost-benefit decision with shareholder capital and saying this is the right defensive mechanism for us to be able to get through the next winter storm. Now, the wires and poles that Drew manages in Louisiana and even in the edges of Texas, as well as the utilities, they have plans. They're going to their commissions. They're getting those plans approved to make sure that the wires and poles are hardened. But I will tell you, our economic incentive is 100% aligned that we need to harden and run well, because if you don't run well in a competitive market, you are still on the hook from a customer point of view, and you owe them that product. And that accountability drives a lot of work by our engineers to make sure that we're comfortable with the kind of weather changes and patterns we're seeing, that we can successfully manage that.
I'm looking at the clock there. I think it's a good time to open for questions of the audience. I know there is a
As sustainable energy becomes more commonplace, how do energy companies plan to increase energy storage both directly and indirectly?
So a couple things. We're in the energy storage business today. As I mentioned, we've had some successes and some failures. I think that's also true when you're on the front end of things. So the facility we put in place in Monterey, California, sits right next to a 1,000 megawatt combined cycle gas turbine plant. And we have 2 other battery installations there as well. But the one that we actually have was a design that I don't think you're going to see repeated. But I think that's an industry learning. We've worked with our heart. We're a finished goods company. I'm going to use my orange juice analogy. We're not an upstream company. We turn various fuels into a finished product, and that finished product is an electron. So we are completely technology agnostic when it comes to what are the tools that help me deliver a finished good. We think battery storage is going to help on what I'd call the average day. So an average day would be sun comes up, there's a lot of solar on the grid, the batteries absorb it, the sun goes down, the batteries discharge. Hopefully in California, it's more 4-hour batteries. In Texas, it's 1 to 2-hour batteries. Hopefully you've gone to bed and you're using less electricity by then, and the wind has picked back up, and now the wind is substituting where the sun was, and you repeat that cycle. That is not the standard of a resilient grid that can make its way through a 3 or 4 day winter weather event or a week of cloud cover. To then get through those events, when I said it took 9,000 megawatts to 1,000 megawatts, we took 24 years of actual weather data, actual cloud cover, wind, solar radiance, and we ran it through the model and said to make it through that you only have 1 outage every 10 years. It wasn't even limiting for duration of outage, just that you only had 1 outage every 10 years. We came up with that kind of math. So I would actually think that while we're always going to push the needle on what long duration storage could offer, I think you're going to find that nuclear and abated gas with CCUS may actually be more cost competitive than the wind solar battery combination. And we need to think about it, again, as a system cost, not just a single asset cost. But we are bullish storage. We're still building storage. We've got storage plants going up in Illinois. Right now, we're converting coal plants to solar and battery. That is not a one-for-one replacement, but it helps the community. It gives them a tax basis, and we're keeping some power in the local region where the coal plant is retiring. We've retired 10,000 megawatts of coal since 2018. No one in the country has retired more coal, and I have mixed feelings about it, because from a CO2 perspective, if we can replace it with renewables or gas, it's a win. From a community impact standpoint, there's a community impact. Those are really good jobs. They mean a lot to that community. And then from a grid reliability standpoint, depends on whether load grows or not. If load doesn't grow, we could probably retire them and work our way through it. If load is growing, we've got to get some bigger chunky assets onto the grid that's helping meet the big chunky load that's showing up on the grid. And I think that's the challenge that we have before us.
What do you see as the greatest legal or policy barrier to ensuring reliability during this energy transition?
You know, it's probably the fact that the certainty of policy. Everyone says that you don't need a guaranteed rate of return. You just need the prospect of earning a return. But that prospect of earning a return has to predict the regulatory framework that you're going to be in. So last year there was a rule around if you're going to run a new gas plant at more than a 40% capacity factor, it has to be abated at the 90+% abatement level. That right there chills a little bit the investment to say, well, can I go ahead and plan on a combined cycle gas turbine? Well, then you have a new administration and they say, well, we're going to repeal that rule. So now you're thinking, well, do I move forward assuming that rule is repealed? I'm looking at Tom here. Tom, you lived this your whole life. And then if there is a change in administration, or when there is, what happens then? I think that since assets are 3 to 5 year planning decisions to execution for gas plants, they used to be 2 to 3, now they're more 3 to 5 because of supply chain. Nuclear plants are probably from thought to finish at least 10 years. That is one of the hardest things, I think, as leaders and shareholders, is to think about the moving target, kind of where's the puck gonna go? I need to be there. That is one of the hardest things, I think, to predict as leaders. And so I think you're seeing the solar, I think, and batteries are gonna continue to do fairly well in the near term because their time from thought to execution is actually pretty quick. And as long as there's still some of these older, like our thermal fleets across the country, on average run 40 to 50% capacity factors. That's the coal and the gas combined with nuclear. If those stay online, they can backstop that solar and battery. If those come offline through retirements, you're gonna have to think through, will the solar, wind, battery get us through, or are we gonna have to hit the pedal on new gas, new nuclear? And I think that hasn't shown itself fully yet, but I think that's the collision that NERC is worried about right now, is where those lines cross.
That is all the time we have for questions.
Can I leave one thought with the team here real quick?
Absolutely.
If you don't mind. I think the question came earlier, what areas should you focus on? I think Bobby addressed this. When we do work in our company, we have our finance people, we have our risk people, we have our engineers, we have our attorneys, we have our HR people, we have our project managers. All of those folks are involved in this work. And I would suggest to you, I have 3 attorneys on my team that are direct reports, none of which is my general counsel. My head of business development is an attorney, my head of retail is an attorney, and my CFO is an attorney, okay? I'm not advocating get a law degree. What I am advocating for is know your subject matter when you study and you come out extremely well, and then embrace the idea that you're probably gonna end up doing something completely different. And companies like ours need cross-functional, team-oriented people to be successful. And so find the culture that allows you to do that, and I think you're gonna have a great career in the energy industry.
That's a great advice for the students who came to see. I would like to thank Professor Sandeep Pillai for bringing them here. This was an excellent session.
Thank you.
I learned a lot myself about the competitive market and all the issues that you're facing and how the industry is looking at the future. So thanks for attending, and I appreciate that.
Thank you.
Jim. Yeah.
Roll wave.